But we have Dhiraj Agarwal, who's joining in here in the studio, Managing Director of Ambit Investment Managers. Dhiraj, hi, welcome to the show.
Hi.
You know, a little bit of a pause in the market, but the market is not missing the woods for the trees. Clearly picking up stocks, buying individual names that are looking attractive. How are you feeling now? Are you also stock picking?
Yes, I think it will become a stock pickers market this year, is what I believe, because the easier run is probably getting over, where everything was running. This year, most of this year, I think the markets will become a lot more selective. And at the index or the broad market level, not as easy a run as what we saw last year. So we are going to see 2 or 3 headwinds as we go into the year, starting with perhaps the December quarter result season as it starts to unfold. The one thing which worries me about the results in the last 2 quarters is the sales growth, right? Sales growth is very, very weak at 5 to 7% range. All the earnings growth of 27, 28% is driven by margin expansion. And margin expansion has come because the WPI has crashed.
Right.
So that benefit will very soon start to fade away. And we need the revenue growth to pick up. So let's see.
And that problem could, hit the mid-cap and the small caps even harder, because if you don't see revenue growth and you're only depending on input costs to cool off, that's what could put earnings at a bit of a risk from the broader market. So let's see how that goes. Now, I wanted to ask you for 2024. In the last few years, ITC played a great innings, so to call it, out of nowhere. One of the years belonged to ITC. Last year belonged to Tata Motors, one would say, because the stock doubled. 2024, what do you think? From the Nifty pack, since we're talking about large cap names, who could take the cake?
So, the 2 strong trends, I think, continue in the market without going into specific individual names. One is the PSU space, and within the PSU, especially energy. I think that trend continues. The one expectation one has this year is banks, after a meaningful underperformance last year, will probably come back this year, especially selectively, if not all. Valuations have corrected, fundamentals still look quite strong. So these 2 spaces. Third, as you rightly pointed out, mid-caps. I mean, that's been on a boil for the last 2 years now. This year, I think mid-caps will also go through its own process of separating the good from the bad and not so good. One thing I would like to point out to your statement is that a number of mid-cap or smaller companies is actually growing even revenue at a significantly higher pace as compared to larger companies. So at this point of time in the David versus Goliath battle, it's the smaller boys seems to be winning.
Yeah, I take that point on board. The only point I was trying to make was that some of these companies, they win an order and it already gets factored into the market capitalization.
Yeah.
So some part of that, profitability is already being recognized at current date for the next 2 or 3 years. That's the short point that I was trying to make with select companies.
In fact, yeah, one thing that I've been saying of late is that in the current market, retail is actually the price setter.
Yeah.
And the institutions are price takers.
That's true.
That's a reality. I mean, which is exactly what you said, right? Which is, it reminds me of the market in 90s. 90s, it used to be exactly like that. As soon as an order or news would get announced, the entire NPV for the next 10 years would get priced in 2 days.
So get a little worried when you are in these times, but then, well, you take it and you run with it and you keep your guard up and make sure you participate, I guess. Dhiraj, season's greetings to you, and great that you could drop into the studios. Great to have in-person conversations. Just to go back to that point on financials, the big consensus sort of call is that we'll get a lot of FPI money back in big banks, and Bank Nifty should go higher. But what else? How else should one add financials to the portfolio? I mean, look at what Bajaj Finance is doing. Again, the narrative has been that because of a crackdown on unsecured lending, now cost of money will go up and maybe margins come under pressure. But then you get quality names which come out and put out numbers like the way Bajaj Finance has done, and the market's rewarding it. So should we not miss NBFCs? I mean, what all to put in the financial side of a portfolio?
So. See, market is also a little bit cognizant on valuations. If you actually divide this market into 3 parts, so very high growth companies, where literally what the market is telling us at this point of time is valuations don't matter. And there are a few examples like, let's say, Trent or some of the mid-cap companies, which is very high growth range. Then second bucket I would put is high growth, but not exorbitantly high. I think Bajaj Finance somewhat fits there. That's a space market has become a little sensitive about valuations right now. So Bajaj Finance has been doing well for the last 3 years, but if you actually see last 3 years stock price performance is 10 or 11% per annum return, not the exorbitant 30-40% CAGR the stock used to deliver prior to that. And for that, market is now moving or the investors are moving a level lower. It says, okay, if there's a 15%, 17% growth company available at more attractive valuations, I would prefer that rather than buy a 25% growth company at exorbitant valuation. So the middle segment of the stocks, in terms of stock price performance, is struggling a little bit. The valuations are not cheap enough for it to be attractive. Growth is not high enough for valuations to not matter.
Oh, okay. And where else do you see this playing out? I mean, just to go back to an argument, let's take IT and apply the theory that you just put out. I mean, patchy earnings, nothing very consistent. But now we're seeing, you know, upgrade calls come in and some people are calling for a bottoming out. Where would you place it? It's definitely not high growth, but is it reasonable valuation? And therefore, what's your call?
IT, the big question at this point of time, and we are a divided house within my team, we're a divided house. We had a big debate on IT just yesterday.
Okay.
The big call at this point of time is whether FY25 growth will pick up as compared to FY24. Now, there's a little bit of a people wanting to have their cake and eat it too syndrome here, because we want sharp rate cuts coming out of the US. We are okay with the US economy going through a slowdown, soft landing, hard landing, recession, whatever that terminology may be. But slow down for sure so that rate cuts are high. But we want the IT growth to pick up simultaneously. There seems to be a little bit of a contradiction or dichotomy here, right? So one of the two views is likely to go wrong. Either we won't get enough rate cuts or the IT growth will disappoint. At this point of time, all the data suggests that US economy and some of the other parts of the world is indeed perhaps headed for a bit of a slowdown. So I would personally bet on the view that FY25 upgrades, which people are expecting, might not come through in IT. And in that context, valuations are not cheap enough.
Okay. By the way, I just want to point out that, you know, in the real estate space, there's lots happening right now. Soba is up almost 6%. So just pull up that stock. We told you a while back that it's one of Motilal Oswal's top pick in the real estate sector. And that stock is piling on some weight. Now, how are you feeling about this space? Because it's now front and center in terms of investors, you know, portfolios. But does it make sense even at this point to put more money here?
I think so. The sector is doing very well. So it's a cyclical sector, and these cycles typically last for 4 or 5 years or 6 years. I think we have done maybe 2 years of strong upcycle in real estate. So there is more to go. And all cyclicals will surprise you on both sides. It'll surprise you by its strength, both on the performance of the business as well as the stock price performance, and it'll disappoint you sharply on the way down when the cycle turns down. So I continue to like this space.
Okay, how are you positioned, Dhiraj? So if you have to give me a long-short ratio, what would it be as of now?
As of now, we're running very, very neutral.
Very neutral, so 50 each?
No, my stock book position is probably 5% net long at this point. So very neutral.
Very neutral, all right.
So December we ran reasonable net long. Into the end of the month and early part of this year, we brought it down. 2 months of 8 plus 5.5, right? 13.5, 14%, 2 consecutive months of performance, 8 consecutive up years. At the very minimum, there should be a little bit of a correction.
So you've reduced your long positioning as of now. Okay.
And nudged the shorts also a little bit.
Okay, got that. Dhiraj, what about, are you ordering from Zomato? that was something that
Zomato comes up on all our discussions.
No, you were, I mean, at lower levels, you were one of the, you were in minority actually, when you were saying that you're quite positive about them. But I think the last time you chatted, you said, maybe at these prices, you'll be thinking twice. At current prices, what are you doing besides ordering?
So I'm not buying, but I think I like the stock.
It still has its course to run for
It has its course to run. I think some of these businesses are game changers, right? And how the margins will pan out is anybody's guess. Although looks like at this point of time that slowly they are able to nudge the fee higher, which is what the doubt, which has always been in that case.
Just very quickly, 30 seconds left on the chat, Dhiraj. Since you spoke about interesting businesses, we'll have Ola Electric come into the market. Now, here's a company, it's asking for a $7 billion valuation, and it's loss-making. It's not a new age company, it's not a platform internet company. There's a hard business, manufacturing business out there. But how do you think the market will react to some of these new high-profile IPOs come if they happen to be loss-making?
I mean, on this particular company, I don't know enough of numbers to be able to comment. But market has lesser appetite in general for loss-making companies right now. But if the company is profit-making and very high growth, it's got unlimited appetite for ramping valuations up. So, I mean, DOM's IPO being a case in point, it's a very good company. And one can question whether 90 times P is justified or not. But it's a high growth, excellent company, and valuations is in the creative it's a zone of creativity at this point of time.
Always good speaking to you, Dhiraj. Thanks so much for stopping by and giving us all those views, and wishing you personally as well as professionally all the best for 2024.
Thank you so much. Wish you all a happy 24.
Thank you.
Well, let's
Happy New Year to you.
Happy New Year.
Let's move on then to a CNBC